Good morning and welcome. My name is Jessica Scott and I'm responsible for marketing and communications here at East Capital Group. And today I have with me our senior advisor, Anders Borg. Welcome.
Thank you very much.
Anders, it's Friday. We often have you in our offices here on Friday, meeting with our investment teams and discussing the developments of the week. And it would be great to get some of your perspectives on things that have happened this week. The first question there is, we had inflation numbers, which are largely moving in the right direction, but there is some consensus around there being soft landings. But even so, we saw that the ECB raised rates, the Fed didn't, but then they came back with hawkish comments. Where do we go from here?
Well, I actually think that we're in particularly for US, fairly comfortable position for Fed. Wage increases have come down. If you analyze the monthly rates now, we're basically consistent in inflation and wage increases with Fed's target. What Fed did was actually to raise growth outlook to 2% this year, and they also notched up a bit for next year. They also cut unemployment forecast a bit while leaving inflation forecast unchanged. So that's a fairly positive revision, I would say. I think the rate path that Fed is pointing to is too conservative. If you keep Fed policy unchanged for the whole of 24, which is in the dot plot, you will actually see a very strong increase of real rates between this year and next year, given that inflation is coming down from 3.5% to 2.5%. From Fed perspective. So that's 100 bips in tighter policy. I don't think that it's consistent with the outlook for 25 and 26. Inflation is coming down. So I think when Fed sees inflation kind of anchoring at better levels, expectations being well anchored at 2, wage increases continue to decelerate, I think we are going to see Fed actually cutting rates next year. And therefore, I think the risk-free rate is too high at the moment. I don't think 460 is a correct 10-year US government bond yield, so I think that will correct. ECB is a little bit in a more complicated situation because wage increases are much higher, and we also have much weaker productivity in Europe. But on the other hand, I mean, if you looked at PMIs now, they are hovering below 45 for manufacturing. That implies that there is a kind of fairly strong contraction with growth also being fairly soft in Germany, not only this year, but also next year. So that would obviously help ECB. So I think we are getting very close to the end of rate hikes. And yeah, I agree that soft landing is now the main scenario. But I would also add that there is a bit of a potential for a Goldilocks scenario. If US productivity to continue to increase as well as it did in Q2, I think that could actually be very positive in terms of support for consumption and profits and growth in the US. So I think one should be slightly bullish on the US economy.
And emerging and frontier markets, they're in a very different cycles from developed markets. Where, from an economic perspective, where is the growth opportunity?
Well, clearly the growth opportunity lies in China. That's China and Asia. Even with this geopolitical conflict, China will grow roughly 4.5% to 5% this year and next, which is actually fairly strong as acceleration. But besides China, the rest of Asia is doing very well. We see strong growth in India. Inflation is getting closer to the Reserve Bank of India's target range. We see fairly strong growth in Vietnam, Philippines, Indonesia, Vietnam. And for once in a while, we also see some positive action in Japan. I mean, it's been a very strong stock market. And I think one has to take on board that from a equity perspective, if I look at the East Capital universe, we have PE ratios of roughly 10. So valuations are much lower than in the advanced markets. While with our strategies, you often have EPS growth between 10 and 20% in emerging markets. And I think for emerging markets specifically, the outlook for next year is a 20% uplift of earnings per share. So yeah, without any really strong multiple expansion, you can actually see at least some of the Asian markets doing fairly well also in next year. So I think we should be fairly bullish. And I mean, let's face it, this is the biggest improvement of human living standard that we've ever experienced. We have roughly 3 billion people in Asia, excluding China, that is growing faster than 4%.
Great, yeah. Turning a little bit then to Sweden, and as of late we've had some negative sentiments on Sweden. We have a weak crown, and we also have some issues within the real estate sector. Is it warranted?
Yes and no. Yes, the real estate sector is a factor of instability. We have a couple of real estate companies that have fairly large bond issuing that has to be refinanced in the coming few years, and Sweden is not different from US or rest of Europe in the sense that e-commerce and work from home actually has a fairly big impact on the real estate sector. So yeah, we have to live through that. So construction will be soft? No, in the sense that this currency rate that we have for the krona makes Sweden extremely competitive. If we look at the relative unit labor cost situation, Sweden has a soft currency, and on top of that, much more moderate wage increases and potentially much better productivity than the rest of Europe. So I think we are going to see a fair bit of export sector pushing Sweden ahead, while we have the kind of problems that we have in the real estate sector. So fundamentally, the protected domestic sector will shrink a bit due to lower consumption and lower construction activity, while the export-oriented sector will actually expand a bit. And from a longer-term perspective, I don't think that's a bad outcome. And we've seen a bit of strengthening for the krona. I'm not into currency trading, and I don't do forecasts for FX because you can't. But it's pretty clear that potentially the krona is substantially undervalued. If you look at the reports put up by macroeconomists, the fair value of the krona is substantially stronger.
Great. Thank you very much for today's update.
Thank you very much.